The Plug Power stock, ticker PLUG, is currently trading live at $2.645.5 per share as of 11:41:55 a.m. Eastern Time, reflecting an intraday movement down by about 0.17% from its previous close. Now, the common expectation you hear about Plug Power, especially when it sits near these multi-year lows, is a simple binary. It's either a speculative lottery ticket that will finally deliver on the green hydrogen dream, or it's a cash furnace set for perpetual dilution. But here's the unexpected angle that's moving the stock right now, and what most general investors are missing. The immediate pressure isn't about the overall green hydrogen market or even the long-term project pipeline, which admittedly is impressive with deals like the recent 2GW electrolyzer supply agreement with Allied Biofuels. The real immediate tension point is pure, old-fashioned liquidity management and the capital markets. We saw a spike in the trading volume, reaching over 35 million shares early in the day, yet the stock barely budged, staying range-bound between $2.56 and $2.72. This sticky high-volume action, right after a significant rally from the $2.69 lows and a subsequent retreat, suggests heavy, short-selling activity clashing directly with opportunistic institutional buying, but the latter is being offset by fears of an imminent capital raise. This isn't just theory. We're seeing increased institutional interest, with new positions being established by various wealth management firms and advisory services, as shown in recent 13F filings. But simultaneously, the short interest ratio remains stubbornly high, close to 50% of the off-exchange volume on some days. This creates a psychological tension where even good news, like the partnership with Edgewood Renewables for a Nevada renewable fuels project, is treated not as a pure growth catalyst, but as a footnote to the central narrative of cash burn. The market expects growth, but the reality is that the cost of that growth is still staggering. Let's ground this a moment. The general consensus, especially among retail investors who track stocks using platforms like Robinhood or SoFi Invest, is that Plug Power Inc. is the bellwether for the hydrogen future. They see the large-scale projects, the electrolyzer deals, the commitment to building out a complete green hydrogen ecosystem from production to dispensing, and they believe the big payouts are inevitable once hydrogen becomes a primary industrial fuel source. They look at the sheer scale of the vision, a future where Plug Power replaces conventional batteries and combustion in forklifts, transportation, and stationary power with its GenDrive fuel cells and GenFuel infrastructure. That's the expectation. The reality, however, is more complex and significantly more painful in the short term, especially for a stock at these prices. The reality is spelled out in the financials. The company continues to report massive negative gross margins, largely due to the high cost of its own internal hydrogen supply network and the supply chain disruptions, not to mention the heavy capital expenditure required to build out the necessary infrastructure. While revenue in the last reported quarter exceeded estimates at $173.97 million, the net income loss remains substantial. This persistent negative free cash flow is the harsh reality that clashes with the grand vision, making the stock highly sensitive to general market risk, particularly rising interest rates, which make future discounted profits worth less and financing for capital-intensive build-outs more expensive. This is an essential point to grasp for anyone considering self-investing in a complex sector like this, whether through a brokerage like Fidelity or using a self-investing platform like SoFi Invest. The short-term price movement of Plug Power stock over the last month perfectly illustrates this expectation versus reality dynamic. The stock shot up from its recent lows on the back of encouraging news about production ramps and some optimistic analyst target raises. You even had one outlier raising their price objective to $7 per share. That's the expectation being priced in. But the retreat we've seen since the initial surge, a drop of over 12% in the last week, is the market correcting back to the cold reality of the balance sheet. Daily price swings are amplified, which is typical for a stock with such a high beta and a large retail following. We are seeing extremely high volumes trading, sometimes double the average, indicating a fierce tug-of-war between the bulls who see the long-term climate tailwinds and the bears who focus purely on the cash burn and the near-term need for funding. This volume is not organic, quiet accumulation. It's volatile, news-driven trading that highlights how much the stock is a play on sentiment, often executed through fast trading apps like Robinhood Stock Trading and leveraged products on platforms like Interactive Brokers. This daily volatility makes it a difficult position for those who use intelligent portfolio strategies or rely on Schwab Intelligent Portfolios for passive growth, demanding a more active, almost individual brokerage style of management. The recent deals, such as the deployment of hydrogen fuel cell systems at a Floor & Decor distribution center, are tangible wins demonstrating commercial traction in their core material handling business. But the market largely yawns because the small-scale proven wins are overshadowed by the monumental funding gaps for the larger, multi-billion-dollar green hydrogen projects. The market is looking for evidence of profitability, not just activity. The core business model of Plug Power Inc. revolves around an end-to-end hydrogen ecosystem. It's not just selling fuel cells, it's building and operating the infrastructure to produce, liquefy, store, transport, and dispense green hydrogen, primarily using electrolyzers powered by renewable sources. They sell the GenDrive fuel cells for motive power, notably in material handling, forklifts, which is their established base, and increasingly for on-road commercial electric vehicles. And they sell the GenSure stationary power solutions. The most capital-intensive and future-critical piece is the GenFuel hydrogen supply and fueling infrastructure. They essentially want to be the Amazon of hydrogen power, controlling the entire logistics chain. This business model is incredibly compelling in theory, especially with government support through initiatives like the Inflation Reduction Act, but it requires massive upfront capital. Looking at older reports, you see a consistent pattern of high R&D and S&GA expenses coupled with negative gross profit, a structure that can only be sustained by regular capital raises, which in turn leads to dilution for existing shareholders. This is the structural headwind that long-term investors must grapple with, regardless of how promising the technology or the market opportunity is. Fidelity, which offers a wide array of Fidelity ETFs and Fidelity mutual funds, might have clients invested indirectly, but for the direct share owner, the constant need for capital is a heavy weight. Looking ahead, the future outlook for Plug Power Inc. is entirely predicated on a few key catalysts and risks, all tied back to the expectation versus reality framework. The greatest near-term expectation is the successful execution and ramp-up of their hydrogen production plants. If they can successfully bring more green hydrogen facilities online like the Georgia plant and meet the promised production volumes, the reality will exceed the current skeptical view because the cost of hydrogen for their customers and, critically, their own margins will improve dramatically. The market is waiting for that tangible proof point that shifts the business from being a project builder to a profitable operator. Another significant catalyst is the clarity on U.S. government subsidies and tax credits, particularly related to the production and use of green hydrogen. Regulatory certainty is the wind beneath the sails for the entire sector, and any clear favorable legislation would instantly be priced into the stock, overpowering the short-term liquidity fears. The risk is, of course, a slower-than-expected production ramp, further supply chain hiccups, or an increase in the cost of capital, forcing more significant dilution through equity offerings. This dilution risk is the central component of the bear case, a seemingly endless parade of new shares hitting the market to fund operations. We also need to keep an eye on competitors and the pace of development in battery technology, which acts as a constant competitive pressure. The hydrogen industry is a high-stakes arena, and execution risk is high. For those who use services like Interactive Brokers trading platform for their extensive charting and data, watching the volume patterns around major news releases will be critical to gauging whether the market believes the company is finally turning the corner toward profitable scale. The next earnings report in November will not just be about a number, it will be a referendum on their path to profitable gross margin, setting the tone for the entire clean energy sector and the future of online investing in high-growth, high-risk assets. The market's current indecision, visible in the tight, high-volume intraday trading range, is a perfect reflection of this central tension. The company's long-term success hinges on turning large-scale project announcements into actual, profitable, operational assets, making the bold investment thesis a tangible financial reality. The risk of dilution, which constantly hangs over the stock like a dark cloud, is the necessary financial evil required to build the future of green hydrogen. The question for every investor, whether you use a simple Robinhood app for fractional shares or a more sophisticated interactive broker's account, is whether the eventual reward of a multi-billion-dollar vertically integrated hydrogen company outweighs the certainty of near-term pain from capital raises. This is the essential framework for understanding Plug Power. We've seen significant new positions taken by institutions, suggesting big money sees value at these prices, but the persistent selling pressure means they are also very sensitive to any setbacks in the financial execution. The next earnings report in November will not just be about a number, it will be a referendum on their path to profitable gross margin, setting the tone for the entire clean energy sector and the future of online investing in high-growth, high-risk assets. The market